Markets finishing the day mixed with the Dow hitting its fifth consecutive session of gains. Here to help us break down all of today's market action is Brian Levitt, global market strategist at Invesco. Brian, it is good to see you. And I want to start on one topic, Brian, that's certainly getting a lot of attention, which is Nvidia, which is taking a breather here, Brian. And, I think a lot of investors are just wondering, can the market keep rallying, Brian, when you have a giant like Nvidia hitting the pause button here? What do you think?
Yeah, I think the pause button's a reasonable word for that. Let's remember we've seen an unbelievable advance in that name. I mean, the irony is that when Nvidia was leading, or a handful of names were leading, people were bemoaning that too, hoping to see a broadening out. So if we do continue to see this broadening out in the market, that's actually a healthier environment. That's a better backdrop. So, I believe that if the Federal Reserve can successfully normalize the yield curve without, any type of recession in the United States, which doesn't appear to be in the cards, that should be a good backdrop for risk assets, even if a couple of names at the top, which had moved substantially, need to cool off a little bit here.
I mean, Brian, that said, there has been a little bit more noise being made by folks who watch the Fed that the risks now are more weighted to them acting too late, and that the risks of a potential recession are rising. How worried are you about that?
Well, I'm not overly worried about the risks of a recession. I mean, when I look at the indicators that would suggest to me if we're having a recession, I would expect to see corporate bond spreads or yields relative to the risk-free rate blowing out, banks tightening lending standards significantly. So we're not seeing that. We're just seeing signs of slowdown in the real economic data. But I do agree that the risk is to growth, not to inflation. I mean, the inflation story is passé at this point. And so, yeah, I would like to see the Federal Reserve start to ease. I believe that 525 to 550 Fed funds range in a world where their preferred measure of inflation is at 275, well, that's just too tight. And it's time to start bringing those rates down. Again, I've told people before, they don't answer my phone calls, but I certainly expect to start seeing that as we move towards the end of this year into next year.
And Brian, what if they don't ease, though? Would that change your view of the market and where we're headed in 2024?
No, I don't think that, certainly not in the near term. I think the Federal Reserve, to me, whether it's September or December is largely immaterial. It's more that the easing cycle is commencing. Now, the longer they wait, the risk to the economy is larger. But the good news is there's not a lot of leverage and a lot of excess in this economy. So even though we've been inverted now on the yield curve some 19, 20 months, the economy's been able to be resilient through that, again, because it's not a classic cycle. We don't have a lot of leverage. We don't have a lot of excess. So I don't think that, the Fed, whether they do it 1 month versus the other month, is necessarily the big risk. It's more that if they just misinterpret this environment and stay on hold, indefinitely, well, economy's slowing. It could likely use a little bit of help here.
Besides the Fed, the other big thing that we are watching, Washington related, is, of course, the presidential election. We've got a debate coming this week. We are going to be hearing from the Treasury Secretary, Janet Yellen, here on Yahoo Finance in just a few. And obviously, there's a lot at stake economically in terms of economic policy. What are you focusing on that front when it comes to the election?
Well, one of the things I'm trying to do is calm people's concerns about it. People tend to get very worried that something's going to happen in an election environment that is going to meaningfully change the economy or meaningfully disrupt markets. That's not how it works. If you go back in history, you'll find that most election years, the markets have done just fine. Volatility hasn't picked up significantly. And you've seen the only time you've seen markets underperform is really in recessions, 08 and 2000. So beyond that, the markets have done fine. I mean, what you want to hear now, I think they're both going to pursue a pretty America First agenda I don't know if we're going to get a lot of details about that on the debate stage. You'd want to get a better understanding of where tax rates are going to be in a second Biden administration. But I think the bigger message to investors is that it largely doesn't matter as much as they expect it to. Even if you look at the last two elections, the performance from the days that Trump and Biden were elected in November 16 and November 20, the market performance of both through their first 900 and something days, trading days in office, is almost exactly the same.
So it sounds like, Brian, what you're telling clients when they're asking you is, listen, it's important, but what you seem to be saying is it's important, but it's one variable among many.
Yeah, it's certainly one variable among many. And when I think about markets, I mean, it's always to me, what's the direction of the economy and what's the Fed going to do? And, right now, it's a global economy that's been fairly stable in aggregate. And the market, with some broadening out, seems to think that things are getting a bit better around the world. And you have the Fed that's likely to ease. So to me, that is more informative than whether I had a crystal ball right now to tell you who wins the White House, who wins the Senate, who wins the House of Representatives. I'd far rather have clarity around which part of the cycle we're in, the next most likely direction of the economy, and what the Federal Reserve is going to do.
Brian, thank you so much for joining us. Appreciate it.
My pleasure. Thank you.